Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is midsummer. It's July 11th, and this is our last podcast of the 2024-2025 season. And with the rock star lineup for the final episode, you couldn't bat it out of the park better than this. And we have Brent crude oil trading this morning, knocking on the door of $69 a barrel, and sort of hanging on to its fingertips to the peaky heights of $70 a barrel. We sort of were asking earlier in this week whether $70 was going to be a ceiling or a floor. If it could hold and close above 70 through the week, then maybe it could establish a new floor. It hasn't managed to do that, closing out a little bit lower than that yesterday, but nonetheless still within distance. Let's kick off this morning in I was going to say in London, but it looks like Paul Horsnell is somebody else. Is that Austrian flag? I think it's the Austrian flag. Head of Commodity Research at Standard Chartered Bank. Paul, what I'm wondering this midsummer's day before we all put on our Speedos and go to the beach, that's an image you don't want, I understand, but I thought I'd throw it out there just for a bit of crack on this midsummer's day. What is the North Star for this oil market? I mean, as we sort of go into the deeper summer break and we go, what momentum are we going in with? We had the OPEC seminar this week in Vienna. It barely felt like they seem to be arguing about journalists not getting access rather than what's the supply demand outlook for the next 6 months. Your store, what's the kind of North Star that all the traders will be taking into their summer holidays?
Yeah, morning, Sean. And that is indeed Vienna stretched out behind
Oh, it
me.
is. Yes. Okay. You've
It,
been there,
it,
so great. Wonderful.
it's rather cold and rainy, but
Oh, really?
otherwise as beautiful a city as ever. Yeah, I think there's well, first just to correct you on the seminar, there wasn't any arguing about the journalists inside the seminar. I think that was coming more from the perhaps from the journalist,
Not
from
getting
some
access,
elements
I
of
think,
journalism.
was
But I mean, again, just put the record straight on that. Bloomberg Ashok was there. There were more media partners than ever before. I mean, this isn't a press conference. This is essentially OPEC's once every 2 year party. And I don't invite all the press agencies when I have a party, and I don't think they invite each other to their own parties. And so in that sense, they could cover. They were journalists outside. It's certainly not.
the Austrian police weren't instructed to arrest
No, no,
journalists
absolutely
loitering
not.
on the street.
Absolutely not.
Anyway,
I think
nonetheless,
that's
not to
anyway. But
distract,
just
from
say
this
from there. I mean,
distance, it made a bit of a noise.
that's that's a sort of just a distraction, and that's not really true. But no, I think in terms of the market, I think obviously the key thing here is the continuing shift in market perceptions of the fundamental supply and demand. We started this year with this dominant consensus that there's so much spare capacity, prices have to remain low, demand's going to remain horribly weak. There's so much supply coming, it's going to come from everywhere. It's going to be a flood from Guyana, Canada, the US, Brazil. And so this very, very bearish narrative based primarily on that there's a huge amount of spare capacity and that non-OPEC plus supply is increasing very fast. I think if we roll on into July, the spare capacity is clearly much more limited than people thought. I think the rolling back of the November 23 cut of tiers has revealed that spare capacity was never as large as people thought. Demand isn't that weak. The market has remained neatly in backwardation. There's always been a bid at the front end of the curve, certainly not at the really low numbers of 200,000, 300,000 annual growth, which many in Wall Street were pushing at one stage. And likewise, this flood of non-OPEC plus oil is just not there. The US is slowing down, flattening out, starting to turn over. You need a lot more than one Guyana really to affect those overall global balances. So I think the playing out of that dynamic is the key thing from here. The market adjusting to the idea that spare capacity is lower, that demand
So
is
this kind of
stronger.
this sort of 6 million barrels a day of idle capacity that
Oh,
was
it's
sort of,
nonsense. It was never.
I
It was
mean, that's
never.
what the quote unquote cuts are amounts to, right? They're
Well, I
fictional
mean,
now.
that's why it's a very good idea, I think, to unwind these voluntary cuts because they were, the market was clearly getting confused and believing all of that was spare capacity when it isn't. So it's a much purer market, much easier, I think, to understand. So, having got rid of the first the November tier, the second tier. I mean, I'd actually start getting as quickly as possible rid of the first tier because again, that's confusing. Assume that that is spare capacity and that if you took off if you added or unwound 1.6 million of cuts, you're going to get 1.6 million crude, and you're not. You're going to get much less than that. So I think just in terms of the way the way the market processes information, it's got to the point where those voluntary cuts have served their purpose. It's let's get it back to a sort of a purer basics and allow the market to see the true fundamentals, which are clearly not 6 million barrels a day of spare capacity.
Rachel Ziemba, adjunct fellow at the Center for a New American Security, senior advisor at Horizon Engage. Rachel, thank you. And your thoughts again, it sounds from Paul's point of view there, the sort of energy markets universe goes into its summer holidays with a sort of a cold shower of awareness that this is a much tighter market than the narratives of the first half. Your thoughts on that? What do you think the energy markets should go into their summer break with their North Star?
Yeah, well, sitting here in the United States, sometimes I wonder whether there will be much of a summer break, and that has to do with things going on outside the energy markets, mostly tariffs and other dynamics. But I'm also struck by the fact that um, global markets, both the oil markets this time and general macro, have been sort of shrugging off what I think could be very extensive, increases in tariffs. We'll see how that goes. But yeah,
I mean,
it
is it
does
another
seem to
wacko moment on that point, Rachel? Or is this time
wacko
I
or
really
taco.
mean
Well,
it? Or taco as
well,
wacko? Wacko
I
taco, yeah.
I think where we'll probably end up, and I'll look forward to coming back in the fall, and you can let me, we can talk about where I was right and where I was wrong, and so on. But is that we'll end up with tariffs higher than they are now. They're probably not going to be the full extent of these sort of letters that have been coming out. And as we come on air today to timestamp it, this is just after. Um, Tariffs were threatened on Canada, the one of the largest trading partners. But I bring this up just in this context as I think I agree with Paul that some of this additional capacity and the like was more level setting to what some OPEC Plus members were already producing, right? And I will say that it's been very complex to sort of figure out what's the cut, what's the sort of level, and in this sort of context. So I will say that demand has held up better than I'd anticipated, but I'm still sort of watching the fact that especially out of China, growth is much less petroleum dependent. There has been a shift towards power. Some of these structural shifts are with us. But the issue is that some of the OPEC Plus members are not producing to their, some of the more restrained ones are not producing to their full capacity. But from a demand side, I see a degree of resilience. And I see a story where um, at least for now, we are not seeing a meaningful overall demand hit from the tariffs. But I think we'll see some more distortions, not so much on the energy side, but in some of the financial markets, if even half of these sort of new tariffs are implemented. So I would be watching that. I think that the overall markets beyond the energy markets are maybe a little too complacent to that risk. And if they are, it actually increases the chance that Trump doesn't chicken out. So those sort of dynamics. So are we going to see an average move to a global price, not global price, but global tariffs of 15-20%, which when you aggregate everything up that's been announced over the last few days, we might see? No. But I think we're still seeing a dynamic of where the U.S. fiscal position is weakening despite the tariffs, and we're still seeing a circumstance that I think will, be challenging to medium-term growth in the U.S. and elsewhere.
Well,
And we're seeing a market.
you would think globally. I mean, at those levels of tariffs, there have to be some kind of break on. I mean, normal economics tells us that. I don't know if we have normal anymore, but if you have 20% tariffs from 2% to 20% average, geez, that's got to be hard breaks on the global economic growth story. Let's go to James Lear, International Relationships Manager at the Gulf Mercantile Exchange, which is a partnership now between the CME and also the Tadawul Saudi exchange. James, what is the technical structure of the market telling us about where traders are positioning themselves through for their holiday season? What bets are they putting on that they won't, so they don't have to get off the beach every day and check their Blackberries, I was going to say, their smartphones.
It's interesting, Sean. Remember the last time I was here was just I think we were the week starting after the Israeli and the Iranians exchanged missiles, and there was a feeling on the Monday morning that the market was slightly underdone. I think we found, and I think I referred to it as a base camp, around about $75 to $78, and there was a feeling in the market that that was probably $10 lower than expected. And that gave you the indication that traders in the market looked at the downside risk as higher than the upside risk. It's interesting. I thought the recent sell-off back to the 60s would have been more sustained. There looks like there is a bit of resilience there. Is 70 a ceiling or a floor? I would say cautiously, I think it's a ceiling. I think we'll see prices in the 60s, and that's the feedback I'm getting from my customers. They think we're probably stuck in this 65 to 70 range for a while yet. The caveat being, of course, that there are no surprises, and the one thing we do know about this year so far, it's full of surprises. So we'll keep an eye on that. But the feeling in the market is we are where we are, that we could have been slightly lower than this, but there is a slight resilience in the market. So we're trading around this high 60s rather than mid 60s at the moment. But I think the traders got an eye on the downside.
Paul, we also went yesterday at the OPEC seminar in Vienna, the World Oil Outlook, the OPEC sort of annual long-term forecast was published. And obviously, as it quite often is, and on this occasion, it seems sort of resurgently so, quite bullish on the demand outlook, 123 million barrels a day call for by 2050, which is sadly only 25 years away. Ultimately, with the combination of what you said in your earlier comment, i.e., this is a tighter market than the sort of general oil markets ecosystem was calling in the first half of the year. I mean, not long ago, in the early days of the Trump tariff nightmare, it was sort of like recession is coming tomorrow. None of that has transpired yet. So we have this more bullish sort of tight oil market as it stands in the first half. In the short term, we've got world oil outlook from OPEC telling us that longer term demand is very robust from their opinion, and they're calling for this year 1.3 million barrels a day of demand growth. So all of that in your bucket. Did you hear from the international OCs, the international oil company CEOs who are all in Vienna as well, that they're now, God, hearing this story, I'm putting lots of billions of dollars in the ground to, increase capacity. Why leave all that party to UAE and Saudi and Kuwait? We're going to start putting a lot more oil money in the ground given this outlook. Your thoughts on where that money's going?
Yeah, I think probably the major sort of change in sort of what was being spoken about on this particular seminar was wrapped up in that, but I think it was more generally moving to perhaps a slightly more, if you like, grown-up dialogue about the energy transition, and that it should be, really about the decarbonisation of energy rather than trying to get hydrocarbons out of the energy mix at all costs. So I think there was definitely you felt from, I wouldn't speak on companies in particular, but just generally from the industry, both national companies and international, a sort of a pivot back to saying, look, the energy mix is going to have a lot of oil and gas in it in the future. It's needed as part of the overall transition. The OPEC World Oil Outlook has oil and gas still above 50% of the global energy mix by 2050. So you just felt a little bit of a movement away, and that came also, it wasn't just from the companies, I think from consumer countries and consumer country representatives. Again, a sort of an acknowledgement of, okay, well, let's not so much start with a clean sheet, but just look at this a little bit more sensibly. And the biggest, I think, the thing that kept coming back in every single session was global energy poverty. The 1 to 2 billion people who on definitions have energy poverty, the extra population that's the demographic increase out to 2050, and sort of perhaps moving away from perhaps the rich person's problem of, what am I doing by energy mix, to the bigger problem for the bulk of the world's population, which is how can I get the energy necessary to do really just sort of basic survival in many cases. So I think it was a much richer sort of dialogue, and more than just beyond the level of, oh yeah, oil is looking better than before. I think it was just generally, as I said, probably more calmer, mature, and right the way across. And everybody's talking about the same things from more or less the same angle for a change, rather than a net zero component and then a non-net zero component. It sort of fused together much better. So I found that actually very encouraging, that now at least the bits can talk together using the same sort of narrative and same sort of language, and start to address the problems.
Rachel, given that it seems to me that for some time the major IOCs, the international oil companies, have been reluctant to put too much money in the ground for new capacity because of this hovering, ginormous idle capacity that OPEC Plus kept telling us about for the last number of years since COVID, that they were carrying forward in order to sort of balance the market. Now we're hearing, it seems a little from Paul and obviously from a lot of reporting, that there's a lot of fiction, or a lot of that idle capacity doesn't really exist. Does that seem like a fair assessment, and B, does that not open up the gateways now for the IOCs to get more brave? Your thoughts of those two things coexisting going forward?
Yeah, and I throw in another, sort of challenge, which is not just assessing the demand, but also assessing the cost curves and other dynamics. And maybe that then drives where the investment goes, right? And so I think, Paul's point and yours about, why would, the IOCs want to sort of give this space to the state-owned, oil companies. And I think there is definitely some of that, and there are jurisdictions where the IOCs are excited. I will say that, speaking to folks in the oil patch, both larger players and especially the smaller independents in the United States, there's still some pessimism. I think that came out, some of it's a little bit, dated, but it came out in the recent federal, sort of Federal Reserve of Dallas sort of surveys of producers in the, in their region, sort of concern, not so much on the demand side, but concern about the costs. And that's where I think, again, we come back to the tariffs, and I apologize for my one-track mind, but I do think
You are in
these
Washington.
elements, yeah, I spend a lot of time thinking about it, but the uncertainties relating to the steel and aluminum tariffs, the other inputs, we're now facing perhaps on August 1 significant copper tariffs. That's quite relevant to tackling, energy poverty. Maybe it will mean there'll be more copper available for other countries who want to be building out their grids. So maybe there's a silver lining there at a global side. Maybe same thing for Chinese led solar panels and their availability for third countries. All right. So I mean, I think it's always good to look on the bright side here. So I think it may frame which jurisdictions. Now, if there is less excess, sort of excess capacity competition in that way, that could mean that even investing in the US oil patch could be attractive. But I think we might well see the other, there, I think, some pockets of greater positivity. There continue to be questions about the split between oil versus gas and liquids. I think for much of the year, there'd been more pessimism on oil and more optimism on the long-term LNG and the like. And I think as markets have been, short term, yes, that trend may well sort of stay. But I think looking out over this sort of medium term, thinking about the new capacity on the LNG side coming online between now and 2030, maybe we might see some relative optimism or pessimism start to sort of shift there. But that's going to have some impact on the long-term contracts and the like. So, it feels to me a little too early to say where all the rebalancing
Yes,
is going to
it
come.
seems like it's kicked off with these increases over the last 3 months that are ongoing,
Hmm.
but the
And have been
rebalancing
absorbed.
and have been absorbed. I mean, in the sense that how much of them have been real barrels versus quotas, but nonetheless,
Exactly.
it's been absorbed by the market as a narrative. James, coming back to the here and now, mid-July, going to the summer break, you mentioned there that there's a downward sort of tone to the position. There's still some downside here. What do you think the buy if you're going?
Oops. Did we lose Sean?
I think we
Yeah.
did.
Sean, are you there?
Go for it, James. So where's the downside coming from? I
Yeah.
think was where the
Yeah.
question was going.
Well, I mean, the downside, as we would all imagine, would be coming from like from
Hmm.
tariffs and the fall off in demand that would entail. But I guess the upside would be, I mean, the trouble, the thing with Trump and his tariffs is that it's a big if, right? We don't know if
Hmm.
he's bluffing or if he's going to stick to it. If he sticks to it, now the IMF are saying there's going to be a drop in global growth next year, which is quite considerable. Now, if that drop in world growth is that, then we're going to see a fall off in oil prices. There's no or
Sorry,
energy
guys.
prices. Okay.
My Zoom crashed. I was just asking you, James. I don't know if you heard me there. I was saying, what do you think is the automated buy signal for? You mentioned that you felt the traders are going into the summer holidays on the downwards, still on a bearish sense that there's more downside here. What do you think the buy number is that so they don't have to watch their phones every day?
Well, I think the downside risk is as we were just saying there, Sean, was is tariffs and in the inevitable fall off in demand in energy. The IMF have already said, next year's global growth rates will be down considerably if these tariffs are enforced. But that's a big if, right? Now, I think we don't know the way that Trump is thinking or whether he's just using this as a bluff. Um, if
But if
so,
you're a trader and you're going on your holidays, you got to take a position, right?
yeah, I mean, as I said earlier, I'd be more inclined on the short side, with a nice stop around about $75 on the upside. But you know, the if we can find a solution to these tariff threats, or there's some kind of agreement that at the moment doesn't seem close, but could happen. We don't know. The surprises, as I said earlier, and this year have been many. There does seem to be there's an innate belief in this part of the world in demand resilience.
Well,
They can't.
clearly, you saw that in the OPEC numbers yesterday, the world oil outlook, still quite
Exactly.
bullish over the midterm.
Yeah, and that may well be justified, and it may be they may be privy to factors that we just don't know. But the Chinese are just going to dig their heels in, or all the other major customers of the Middle East are going to dig their heels in and continue with massive mega projects, domestic, etc. Then demand will be consistent. But there seems to be that belief in this part of the world. So I'm not as bearish as I was perhaps a week or so ago. And if I was on the beach, which obviously I'm not, Sean, because I worked too hard.
Well, you're on this strange green beach you've got sort of
Yeah,
behind you here.
look
It's
like
sort
I got
of you're
wings.
like an
Uh,
angel. You're the energy transition angel.
the green angel. Yeah, if I was, I would have my stops in around about 75 and be looking for any kind of resolution to these tariffs, which I think are the biggest downward pusher. Because as
Yeah.
I said, there seems to be demand resilience.
Okay, let's go to the survey question, which is sort of tracking on this point. Brent crude oil is trading at 69 approximately today, midsummer. What will it be trading at the end of the holiday season, September 1st, which is they call in America, I think that's Labor Day weekend. And once you come out of
Mhm.
Labor Day and the harsh reality of a new winter looks you stare in the face, what will Brent be screaming off the screens? 70, nearest closer to 75 or above, 70, closer to 65 or even closer to 60 and minus, that some of those downside risks can't be discounted. We saw the last time Trump went mad in early April with the sort of Liberation Day tariffs, which he seems to be barking again, 50% against Brazil because he doesn't like Bolsonaro going on trial. I mean, these are all sort of I'm going to reopen Alcatraz type headlines. Are the substantial? How serious do you need to take this taco thing if you're going on your holidays? How much can you afford to believe or not believe? So what's your number there? Closer to which one of those? Paul, I suppose a lot depends on the positioning over the next 6 weeks, on how much you buy into the narrative that has been dominant in the first half that you said was getting sort of killed in Vienna this week, which is that the second half is when the surplus will come. That's been quite a dominant narrative that all of these increases from OPEC Plus, yes, they're not really tangible yet, but they're going to become very tangible. And demand growth, give or take, is around 1 million this year, and supply is well beyond that. So you got to prepare for the downside here of surplus supply manifesting in a way that it hasn't yet. Your thoughts on that and where we'll be at on September 1st?
Yeah, well, I think it's probably more about seasonality from this point. So
Mm.
Q3 is where it is going to be the tightest quarter just because of the seasonal pattern in demand. I mean, as we sort of look into, the weakest quarter these days is Q1. It used to be the other way around, but and in Q1, that if there's going to be a surplus, Q1 is where it should manifest itself. I mean, on our numbers, yeah, we get a surplus to Q1, but it's what I'd call a completely normal seasonal build in Q1. Remember, we're starting from a base of low inventories. I don't believe these hidden inventories, the story of hidden inventories. I mean, that's an old trope that if the market's not going the way your balances say, you say that these barrels are somewhere else. They're in China, in South Africa, or whatever. So starting from a low inventory base, there's some slack there for inventories to build, and we will need probably a seasonal build in Q1 just to start that process. So there's a lot of slack in there. So that's what's suggesting that this maybe there's a possible window here for OPEC Plus to do all this cleaning up, get rid of that other tier, and then look at the market and see what kind of rebalancing is needed. But in terms of the
Just to be pushed back a little on that, just to be devil's advocate here, how normal can things be in a world in which China oil demand growth doesn't grow anymore?
I mean, Well, I mean, it's never normality is sort of in the world all outlook and up to 2050. Normality doesn't involve China growing at very fast rates, and we've already adjusted down to lower rates and then a sort of leveling off of
Yeah, but in the
China's
immediate
demand,
sort of
which is in
the immediate
there.
year that we're probably in one of the first years, last year, now this year, of no global oil demand growth from China. But that has to have an impact on normal curves and normal seasonality, no? Or it's
Well,
just
I mean,
blended in the
I think
noise.
Mhm.
you've taken a global oil demand said this. Even with that global, it's probably a good thing for the world economy that China has slowed down in that sense. Because if you'd thrown in an extra 500,700,000 from China into the demand equation, it would be ridiculously tight by now. No, no, it's easy to just sort of focus on one country and one thing. So it's Guyanan supply, Chinese demand, and so on. I think we take it in its total. There's all swings and roundabouts. Things speed up in one place, slow down in another. Still getting a fairly, 1 million plus of demand this year. That's pretty close to the average for the past few decades. There's nothing particularly remarkable. The biggest impact for me, though, is that slowdown in non-OPEC plus supply. It's a much bigger slowdown to have the US going from, in total liquids, 1.6 million barrels a day of growth in 23 to half that, 800,000 last year, to maybe a quarter of that this year, down to a few 100,000, to flat to down next year. That's a big change. That's taken makes the profile, I think, is more important than the slowdown in China demand. So overall, it's markets balance. They find their sort of way round.
So
But
September 1st, Paul, to put you on the spot, lower or
oh,
higher
I
than where
hate
we are
doing
now?
point
Lower
estimates
or higher,
because
lower or higher,
in
lower or
a
higher.
market like this, I mean, it can be $5 higher the next day and or
Yes,
$5
yes,
higher the
yes.
day before.
Yeah,
But
I know,
I
I
think
know.
from this point,
We're back in the 60s, I suppose. That's a good thing
no,
for
I
all
mean,
of us.
I went for 70 plus on the
Oh, you
basis
did.
that
Okay.
there's an adjustment coming through. But I agree, at some point there is, we still have a lot of economic risk. This rebalancing I'm talking about and sorting out the quotes, that could get a messy process at some point. It needs to be done, but it isn't going to be constantly good news coming through from there. So sideways a little bit up seems reasonable,
Right.
but
Okay.
never do a point estimate of the oil price, Sean. It's
Rachel, last word, your last word before we get James's last word, but quickly, your thoughts on the immediate outlook. Does that supply surplus dampen downward, or are you with Paul and thinking we might have a plus here?
Yeah, I mean, I'm watching. Look, we went into this sort of in the last couple of weeks. We started to see, particularly in the U.S. inventories, having been drawn down, which put, I would say, sort of the U.S. in a very different position than China, for example. Of course, the U.S. is a larger producer. Again, a little bit of tightening there. My thoughts, I picked a sort of a trading range that was only a little bit lower than where we are now, just to sort of, I think somewhat similar, gapping up a little bit, but not meaningfully higher. So far, I mean, I went on a bit of a road trip over the July 4th sort of long weekend. Gas prices are not particularly, sort of high, right now and the like. So I guess I'm also
And you were in
watching.
California,
um,
right?
I was in upstate New York,
Oh, New York. Sorry. Okay.
and
It's
so
California
not
where
a
the
not
prices
not
would
a
be,
cheap
be
not
high.
not a cheap gas part of the country, but not the most
Yes.
expensive
Yeah.
part of the country.
Right. Yeah.
But I am watching whether we're actually going back to kind of a driving season, a power season. We'll see when that demand sort of dynamics. But yeah, I mean, I do worry about the Chinese demand trajectory. Maybe Paul's right that it's a good thing that they're no longer guzzling as much, but I also worry about the non-energy related piece of the way in which China's driving its growth, which is to export more and import less of other goods beyond energy. And so I worry about whether there is more production not of goods, of manufactured items that might struggle to find its consumers. So I guess
Yeah.
there's more of a macro story that I
Yeah.
worry could eventually in 2026 end up negatively affecting the energy markets. But we'll see. I think people like myself have to use our summer break to kind of retally up our fundamentals and see where we're headed into which new scenarios
Well, it
and
certainly sounds
hopefully.
like that with that sort of, if one really grasps the nettle on terms of the idea that this idle capacity of 4 or 5 million that's remaining, whether it's quotas or cuts or whatever you want to call them, it's puff non-existing. That's a pretty big thing to try and get your head around and recalibrate all of your scenarios. James Lear, last word to you. Where are we going on September 1st? You said
Yeah.
75 on the sell side.
Well, 75 with my stop on the upside. I
Yeah.
think the market's going to be around about the 65 level. Um, Let me just add that I don't think that's a bad price for this market to be in. If we're
Mhm.
somewhere between sort of 63 and 68 for the next 6 months, I think everyone is kind of happy, Sean. I think, if we go any lower than that, then, we're going to have a sort of a challenging fiscal environment, especially in this region in the GCC. That's for sure. We might see, if there's a prolonged sell-off in this market into the 50s, etc., then we may see like the cancellation of mega projects and other ways of raising money, either that through borrowing or even, don't mention it, tax. I think on the upside, if you're looking at anything above 75, then something bad's happened. So geopolitically, I would guess. So I don't think we should complain about these prices, and I hope very much that after Labor Day we're trading around about the 65 to $70. I think that's
That certainly seems to be. I think you say don't look a gift horse in the mouth, as they say. I think perhaps the trigger for buys and sells, automated buys and sells, while everyone's on the beach, will be not the numbers of the Brent price, but the numbers of the tariff level. If it goes 20% on China or 50% on Canada, that's a buy or it's a sell. So set your markers by the tariffs, not the headlines, but the actual tariffs. We're going to wrap it up there. Wonderful, a little longer than normal, and I apologize for that, but nonetheless, it's the last of the season, so you'll forgive us. I want to thank you, Paul Horsnell and Rachel Ziemba and James Lear for today, but most importantly, for being with us all season. Your voice is really important to have on this table every month. So really, thank you. Have a great holiday if you're getting some, and I hope everyone is. Recharge, recalibrate, and we will see you all back here from September 1st. And book your flights for Fujairah on October 1st, because in person, like Paul had the joy of being in person in Vienna
Mhm.
this week, once in a blue moon these days in Vienna. Obviously, every year we get the chance to be in person in Fujairah. So have a great vacation, everybody, and look forward to seeing you all in September. Thank you so much.
Thank you. Thank you, Sean.
Thank
Thanks,
you,
Sean.
Sean. Thank you
Guys,
all.
thank you.